Welcome back to the ProTicker Podcast, your Friday morning edition covering major financial magazine headlines, everyone. We're diving deep today into a week that, well, it's been packed with significant developments impacting markets and ultimately your money.
It certainly has been, yeah. A really complex 5 days. We've seen a mix of legal battles over trade, some major corporate earnings surprises, and, shifts in policy discussions. It's created a landscape that feels, well, anything but predictable.
Exactly. And that's why we've pulled together articles and insights from, Reuters, MarketWatch, CNBC, Yahoo Finance, and Bloomberg.
Yeah.
We really want to unpack what's been happening. Our mission for this deep dive is basically to navigate through these headlines, pull out the crucial bits of knowledge so you can understand what's driving the news and how it connects to your world.
Think of us as your guides, maybe, through this week's financial maze, because there's a lot to cover. From, like you said, the courtroom drama affecting tariffs, all the way to specific company results showing how these big global dynamics play out on, individual balance sheets.
Okay, let's unpack this. Let's start with that legal roller coaster around President Trump's tariffs. That really dominated the headlines midweek, didn't it? According to reporting across CNBC and Yahoo Finance, it all kicked off on Wednesday.
That's right. A U.S. trade court issued a ruling that was, well, quite a shakeup. It essentially struck down most of President Trump's recent tariffs.
Strike them down.
Yeah. The court found he had exceeded his authority by using the International Emergency Economic Powers Act, the IEEPA. That's an authority usually reserved for, declared national emergencies, not for imposing these broad kinds of duties.
And the sources were clear. This ruling specifically targeted those country-specific tariffs, right? Like the general 10% baseline tariff applied to lots of countries, and also those duties tied to things like fentanyl trafficking from places like Canada, Mexico, and China.
Precisely. But here's where it gets really interesting. It adds these layers of uncertainty. Just 24 hours later, on Thursday, a federal appeals court stepped in. Reporting from CNBC's Daily Open detailed how they temporarily paused that lower court's ruling.
So wait. The tariffs that were blocked on Wednesday are now back, at least for me.
Exactly. Back in effect while the appeals court considers the case. And this legal back and forth, as multiple sources highlighted, immediately creates, well, uncertainty for markets, for trade negotiations, all of it.
Absolutely. I saw Larry Tennerelli, founder of the Blue Chip Daily Trend Report, quoted by Yahoo Finance, saying something like, "We expect the tariff news cycle to be an extended process, which can lead to higher short-term volatility." That extended process part sounds about right.
It does, and that volatility makes complete sense, doesn't it? It's incredibly hard for markets, for businesses to make plans when the very foundation of trade rules is being debated and, potentially reversed day by day in court.
Yeah, planning becomes almost impossible.
And some sources, I saw commentary on CNBC, presented the view that maybe having certainty, even if it's the certainty of a 10% tariff being definitely in place, might actually be better for markets and, global economies in the long run. Better than this sort of unpredictable on-again, off-again status.
Right. Predictability matters. Knowing the rules, even if you don't love them.
Exactly.
Now, it's also important to clarify, though, that even if that lower court's ruling eventually holds up, not all of President Trump's tariffs would just vanish.
That's a really critical nuance. Reporting from CNBC pointed this out. Tariffs like the 25% duties on steel, aluminum, cars, auto parts, and also certain tariffs on China from his first term, those were imposed under different legal authorities.
Like Section 232, national security stuff.
Right, Section 232 or Section 301, which targets unfair trade practices. Those would likely remain in place regardless of how this specific IEPA legal challenge turns out.
Okay, got it. And how did the market react to this specific tariff drama towards the end of the week? According to CNBC and Bloomberg, Treasury yields didn't move much on Friday.
Yeah, they were little changed. It seems investors were partly waiting for key inflation data, but they were also clearly trying to absorb the implications of this latest tariff development, trying to figure out what it all means.
And there was more, wasn't there? Trump trade advisor Peter Navarro added another layer.
Oh, yeah. He was quoted by multiple sources, including CNBC and Yahoo Finance, saying, and this is pretty direct, "Even if we lose, we will do it another way."
What?
Yeah. That signals the administration's clear intention to keep pursuing tariffs, maybe through alternative legal routes or executive actions, even if this specific court challenge ultimately goes against them.
So the legal fight's ongoing, but the policy intent seems pretty firm. That definitely sets the stage for continued uncertainty.
It really does.
Which brings us neatly to how this actually impacts businesses and potentially you, the consumer.
Exactly. That volatility and the reality of the tariffs that are still in place, they translate directly to real-world impacts. We saw in corporate guidance, costs.
Let's shift gears then and talk about that. We have some specific examples from the source material. Let's start with Best Buy. MarketWatch reported their stock dropped, 8% on Thursday, after cutting their fiscal 2026 profit guidance.
Yeah, and they specifically cited the impact of tariffs as a key reason. It's interesting because Best Buy actually beat profit expectations for Q1, even though they missed on sales and revenue estimates.
So the market reaction was really focused on that future guidance cut, the tariff impact.
Heavily weighted towards that, yes. The company basically said they're aware of the court actions, but it's just too early to factor potential changes into their forecast right now.
And their management also highlighted something about consumers, didn't they? Weighing inflation against big purchases.
Right. They said consumers are really weighing inflation effects against those bigger ticket items like home theater systems, making them more value-focused was the term they used.
Makes sense.
And Best Buy management also said they're actively using tactics to try and mitigate these tariff impacts. But importantly, their current projections assume tariffs stay where they are now, with no big change in how consumers behave.
Okay. And then there was Gap, another major retailer seeing a big market reaction tied to tariffs this week, right? According to Reuters.
That's right. They listed an expected $250 million to $300 million in tariff-related costs for their fiscal 2025, mostly hitting in the second half of the year.
But here's the kicker from that Reuters piece. Gap excluded this estimated tariff hit from their main full-year operating income forecast. Is that right?
That's exactly right. And their shares dove almost 16% in pre-market trading Friday. Apparently, that exclusion really spooked the market.
Why exclude it?
Well, eMarketer analyst Sky Canavis was quoted saying this exclusion likely weighed on sentiment, even though Gap actually beat Q1 estimates and seemed to be benefiting from a style refresh. Gap's CFO, Katrina O'Connell, emphasized it was a purposeful separation. They wanted analysts to see the underlying business performance without this specific sort of policy headwind clouding the picture.
Interesting. So you see how the market reacts, not just to the cost, but how companies talk about it, the uncertainty around it.
Yeah.
It's hitting retailers directly.
Absolutely. And it's not just stuff you buy in a store. Business travel is also feeling the pinch, according to a CNBC report citing a Global Business Travel Association, or GBTA, report.
Oh, yeah. How so?
Well, optimism in the global business travel sector apparently dropped by over half. That's a huge shift.
Wow.
And the GBTA report found that about a third of business travel buyers are either changing or thinking about changing their policies for travel to or from the U.S.
Why? What are the concerns?
The big ones cited were higher costs. 54% mentioned that, and increased administration needs, paperwork, hassle. 46% mentioned that, both potentially linked to these trade frictions and maybe travel restrictions.
There was a nuance there, too, wasn't there, from the GBTA CEO?
Yeah, that was fascinating. A more nuanced perspective from GBTA CEO Suzanne Nufeng. She pointed out that sometimes trade wars can actually increase business trips, at least for a while.
How does that work?
Her point was, basically, companies are forced to seek out new partners or markets when their existing relationships get disrupted by tariffs or trade issues. She was quoted saying something like, you lose a customer, you need to find another one. So I think that perspective doesn't mean all doom and gloom for us.
That's a really interesting counterpoint. So despite the worries, the market's still projected to grow.
Yeah, the projection is still pretty big, $1.6 trillion globally by the end of 2025, assuming things don't get worse, and maybe $2 trillion by 2028. But on the other hand, leisure travel to the U.S. has fallen this year. That's projected to be an $8.5 billion loss, so different impacts on different parts of travel.
Okay, and bringing it back home, to you, the listener, what does all this tariff uncertainty and the reality of existing tariffs mean for your wallet?
Well, according to analysis from the Yale Budget Lab, which CNBC reported on, even with that court ruling potentially blocking some tariffs down the road, the ones still in the books right now are expected to cost the average U.S. household about $950 in purchasing power in 2025.
$950, that's significant.
It represents about a 0.6% increase in consumer prices. Ernie Tedeschi, who directs economics at the Yale Budget Lab, was quoted saying it does pinch consumers' wallets. He explained tariffs are basically taxes paid by importers, and they usually usually get passed on to us, the consumers.
Right.
But he also noted, importantly, that this $950 figure is still a far cry from what the cost could have been if those broader country-specific tariffs originally planned had stayed in place. That could have been much, much higher.
So some potential relief from the legal battle, maybe, but existing tariffs are still having a measurable impact. It really shows how policy, even when it's being challenged in court, has real economic bite.
Absolutely.
Okay, let's connect this back to the bigger picture. How does this whole tariff situation fit into the broader geopolitical and policy discussions we saw reports on this week?
Well, it's clearly playing a direct role in U.S.-China relations. For one, Treasury Secretary Scott Bessent commented this week, this was reported by CNBC, MarketWatch, Yahoo Finance, that trade talks with China are a bit stalled.
Stalled. He suggested it might take a direct call between President Trump and President Xi Jinping to break the deadlock, right?
Yeah, given the complexities, they did reach that agreement back on May 12th to roll back some of the recent really high tariffs over 100% for 90 days. But the sources indicate the fundamental disagreements are still there. U.S. focusing on tech restrictions, China holding leverage on things like rare earth minerals.
It's complicated. Needs top-level engagement, as Bessent said.
Right. Meanwhile, over in Europe, EU officials are apparently seeing the U.S. court ruling on tariffs as giving them a bit more leverage in their own trade talks with the U.S. That was according to Reuters.
Because that makes sense, doesn't it? Internal U.S. policy wobbles could strengthen the EU's hand. And those talks are continuing next week.
Yes, scheduled to continue. And the EU is reportedly sticking to its offer mutual zero tariffs on industrial goods. They're kind of pitching Europe as this destination for a, quote, sane, stable, even boring, rules-based order and predictable business environment.
Huh. Sane, stable, even boring. Sounds pretty good right about now, actually.
Doesn't it? It's a clear contrast they're trying to draw with the legal and political volatility happening stateside.
Okay, now there was another really significant policy item that seemed to have Wall Street a bit jittery. According to CNBC, something about foreign capital.
Yes, this is a really interesting one. It relates to something called the One Big Beautiful Bill Act, and specifically a part called Section 899. The source material described it as potentially the most sweeping change to how foreign capital is taxed in the U.S. in decades.
Sweeping changes. What exactly does Section 899 target?
It takes aim at what the bill calls discriminatory foreign countries. Basically, nations that impose taxes, like digital service taxes, that tend to hit U.S. companies harder, especially big tech firms.
Okay.
France and Germany were named as examples in the source material. France has that 3% tax on online platform revenues, and Germany was reportedly considering something similar.
And what would this U.S. bill, Section 899, actually do?
Potentially, it could allow the U.S. to increase taxes on U.S. source income for investors from those specific discriminatory countries by 5 percentage points each year, maybe taking the rate up to 20% over 4 years.
Wow. Okay, that sounds serious. This is where CNBC quoted Deutsche Bank analysts saying this could turn a trade war into a capital war, right? Weaponizing U.S. capital markets.
Exactly. They pointed out the potential hit to foreign governments and central banks that hold a lot of U.S. treasuries. France and Germany, for example, hold a combined $475 billion worth.
So the yield on those treasuries would effectively drop for them.
Significantly, yeah. Under this tax, it could make U.S. treasuries much less attractive to those specific investors. Beat Whitman of Porta Advisors was quoted calling the idea very bad and huge, and he noted that German bonds have actually been preferred as a safe haven recently, maybe partly in anticipation of moves like this.
So trade policy gets tangled up with tax policy, potentially affecting global capital flows, investment in U.S. assets like treasuries. It's like a whole new front in this economic maneuvering.
It really is. It adds a layer of complexity, potential risk that goes way beyond just traditional import duties.
And speaking of policy connections, we also saw news this week about a pretty significant meeting. Fed Chair Jerome Powell met with President Trump. MarketWatch reported on this.
They did meet. And according to the accounts from both sides, the Fed and the White House, there wasn't exactly a meeting of the minds, especially when it came to interest rates.
No surprise there, maybe. President Trump pushed Powell to cut rates, arguing the Fed's putting the U.S. at a disadvantage compared to countries like China with lower rates.
That was his argument, consistent with his past comments. But Powell's message, according to the Fed's statement, was equally consistent. Policy decisions depend entirely on incoming economic information and will be made with non-political analysis. sticking to that data-dependent stance.
And economists mentioned in that MarketWatch piece seem to think the market basically gets it, that the Fed needs to wait for some of this uncertainty around trade policy, including these tariff battles, to maybe ease up before they can really act on rates.
Yeah, and interestingly, Chicago Fed President Austin Goolsbee even suggested, according to Yahoo Finance, that lower rates could be possible if the tariffs fade away, if the economy could get back to a more stable pre-tariff path. So explicitly linking potential Fed action to trade policy outcomes.
Wow. So tariffs, trade policy, capital policy, central bank decisions, it's all incredibly tightly wound together. This week's headlines really hammered that home.
Precisely. It's a very interconnected global economy. A legal challenge here, a new tax proposal there, can ripple out in ways you might not expect.
Okay, let's try and wrap things up by looking at some other key corporate headlines that moved markets this week, especially in tech, where we saw some pretty different stories play out.
Yeah, the big standout performer was definitely Dell. Their shares climbed nicely after they beat revenue estimates for their fiscal first quarter and, importantly, significantly raised their full-year profit outlook and their forecast for the current quarter.
And according to reporting from CNBC and MarketWatch, this beat and raise was all about AI, right? Unprecedented demand for their AI systems.
Exactly. Particularly strong, they said, from those second-tier cloud providers who are trying to build out their own AI infrastructure. Dell highlighted a massive $14.4 billion backlog of confirmed AI system orders.
$14 billion.
Yeah. And they expect to ship around $7 billion worth of AI servers just this current quarter. Their previous record quarterly shipment was $3.1 billion. So it's a huge leap. That AI momentum is clearly giving their business a massive boost.
And speaking of AI momentum, NVIDIA is still in the spotlight even after its recent earnings blowout. MarketWatch reported their stock climbed even further on Thursday.
Analysts are still incredibly upbeat, apparently, even with the China market largely shut out by restrictions. Sources like MarketWatch point to just huge optimism about the ramp-up of NVIDIA's next big thing, the Blackwell AI platform. They think it's accelerating, supply constraints might be easing a bit, and overall demand just looks incredibly strong as everyone needs more computing power.
So they're still outgrowing expectations.
Seems like it. Analysts believe NVIDIA is still managing to outgrow expectations and fend off competition, even with supply constraints sort of limiting how fast they can actually deliver.
And there was that opinion piece in MarketWatch noting that options traders seem to keep getting NVIDIA's post-earnings moves wrong.
Yeah, an interesting side note, though the broader market itself definitely got an expected boost from the continued signs of AI strength coming from NVIDIA, and now Dell adding to that story.
But not all tech news was rosy. Sentinel alone. Their shares got hammered Thursday, according to CNBC.
Yeah, down over 11%. That came after they lowered their full-year guidance. And separately, they also had a widespread outage, although sources confirmed it wasn't related to hacking in Israel, which some people might have initially speculated.
Okay. And then Apple. MarketWatch highlighted that Wall Street analysts are kind of expected to start piling up downgrades on Apple now, even though the stock's already down about 20% this year.
Yeah, it's partly linked to analyst behavior, that sort of herd instinct John Maynard Keynes talked about.
Right.
The idea is analysts often wait for their peers before issuing downgrades, even if the negative news is already out there and the market's kind of reacted. It feels safer, reputation-wise, to be wrong with the crowd than right on your own, maybe too early. So you might see this delayed wave of analyst downgrades, which could put more pressure on the stock.
Interesting psychology. Okay, beyond tech, we saw some retail earnings reactions. We already covered Best Buy and Gap. CNBC reported Costco beat earnings, but the shares didn't move much after hours. Ulta Beauty jumped after beating expectations, though. American Eagle Outfitters pulled back after missing.
Right, a mixed bag in retail. And CNBC also highlighted some really significant gains in nuclear stocks during May. The Global X Uranium ETF was up 29%, but some individual companies saw much, much bigger jumps. Oklo up 122%, Niscale up 95%, Centrus up 74%.
Wow, big moves in nuclear. And looking ahead, there's the big ASCO Cancer Conference this weekend in Chicago. That usually moves stocks in that sector.
Yeah, definitely one to watch for investors in biotech. Interestingly, the Range Cancer Therapeutics ETF is actually down 10% in May, and the broader S&P Biotech ETF is still quite a bit below its 52-week high, about 24% down. So maybe some caution or sector-specific issues heading into the conference.
Okay. And just a quick note from Reuters this week, a BYD executive said there's no Evergrande-type risk among mainstream Chinese automakers, addressing those contagion fears.
Yeah, trying to reassure the market on that front.
Finally, let's touch on crypto quickly. CNBC reported the SEC formally dropped its lawsuit against Binance and its founder, Changpeng Zhao. Some are seeing this as maybe a symbolic end to a certain phase of the SEC's crypto crackdown, and perhaps positioning the Trump administration as more friendly to the industry.
That's one interpretation making the rounds, but then you contrast that with the European Central Bank. Reuters reported ECB policymaker Fabio Panetta warning banks pretty strongly about the reputational risk of getting involved in crypto services.
He sees stablecoins as a threat.
Yeah, a potential threat to traditional payments. And he suggested a digital euro is becoming more necessary to keep central banks in control of the payment system. So very different signals coming from different regulators.
And just related to that 401k discussion we saw in MarketWatch, it seems unlikely we'll see things like crypto or private equity offered as direct options in retirement plans anytime soon. Too complex fiduciary duties.
Yeah, probably not directly on the menu. It's more likely they might appear within professionally managed funds like target date funds where the managers handle the allocation and risk rather than you picking it yourself.
Right, all these interconnected pieces of the financial puzzle making up this week's headlines.
Absolutely.
So to sort of sum up this week's deep dive, we've seen how legal and policy uncertainty, especially around tariffs, is really driving market volatility and directly hitting company forecasts, consumer costs. That's one big theme. Then alongside that, you have major corporate developments, particularly this surging demand for AI systems, that continue to drive huge market moves in specific stocks like Dell and NVIDIA.
Right. The AI story just keeps getting bigger.
And then there are these broader global trade and finance dynamics shifting, like the potential for that capital war we talked about and these differing central bank views on crypto. It's all adding new layers of complexity to the whole financial landscape.
It really highlights how the traditional drivers we watch, earnings, inflation data, they're now operating within this much more complex environment. An environment where legal maneuvers, political decisions like these tariff battles or that potential foreign tax bill targeting specific countries, these things could be just as impactful on markets and economies as the traditional economic data itself.
It's a world where policy risk is increasingly financial risk. That's a great way to put it. Something for all of you to think about.
Definitely food for thought.
We'll see you all Monday morning with new headlines from major financial magazines.